Good morning and a very warm welcome to everyone joining us live this morning. We have a very special event today in anticipation of the coming Sprott Symposium taking place in 2 weeks from today, this month here in Vancouver. We have the privilege of being joined this morning by legendary investors and company makers, including Rick Rule, Doug Casey, Eric Sprott, Jonathan Awde, and Rudi Fronk. Joining us first this morning is Rick Rule, the President and CEO of Sprott U.S. Holdings. Rick, a very warm welcome to you this morning. Thank you so much for joining us.
Thank you, Vanessa. It's always a pleasure to be interviewed by you.
Thank you. Now, just to start off with here, there's been some, incredible volatility in the resource sector in the last several years, but there's been some even more intense volatility recently in the Chinese stock market. What do you make of the fluctuations that we've seen there?
In terms of the Chinese stock market, I think one of the difficulties that global investors have had is the opaqueness of that market. With regards to the internal market in China, I think what you have is a lot of people that are fairly new to equity market trading, that is the Chinese retail investors. They have opened up an awful lot of accounts in the last year or two, and there are people in that market, I think it's fair to say, just like in the junior mining stock market, by the way, who are fairly unsophisticated punters, and there has been a lot of crowding into momentum trades and crowding out of trades when they roll over. What you would expect.
Absolutely, you're absolutely correct with that, and our stock markets here have been open publicly for the last half decade, but since the whole last century. In China, they really started out with some test zones initially, and investors there, as you say, are probably quite new to it. Now, what do you make of some of the heavy-handed government intervention that we've seen there?
Well, it's not my business to criticize a government that I don't pay tax in, but probably that leaves me lots of scope, by the way, Vanessa. But anyway, I don't appreciate government interference in markets in the United States or Canada, and so pretty clearly I wouldn't favor government interference in China. The truth is that markets work over time. They're messy and they're volatile, and the volatility causes some people loss, and of course when people experience loss, they're looking for anybody to blame but themselves, and often look for what they would term assistance and what I would term interference. I think the American markets, the Canadian markets, and the Chinese markets would all be stronger and more functional markets were there less government interference.
Right. And do you see the intervention, how do you see the intervention playing out in the near term?
My suspicion is that, like most other interventions, it will postpone the reckoning and ultimately make the reckoning more severe. I think a market that wants to find a lower level will find a lower level. The question is, how will it do it? Will it do it efficiently through market clearing processes, or will it do it inefficiently? A really good correlation is, of course, Sarbanes-Oxley in the United States. It was a different form of intervention, but the truth is, after you had a regulatory failure, it was called a market failure. And the U.S. government instituted Sarbanes-Oxley, although at the time of the Enron event, fraud, which is what the Enron accounts were, was already illegal. The consequence of that is that the United States spends about $100 billion a year on excess regulatory costs, money that comes out of the market and money that comes out of the country. It's just a different form of government interference. The Chinese interference was, of course, much more immediate and dramatic, but not much difference between the two.
Right. Now, comparing the two, forms of intervention, do you think that what's been happening in China with the stock markets is really more of an indicator, of the slowing economy there?
I don't. It would appear to me as though for a while the stock market in China, and I'm no China expert, was viewed by the government as the preferred outlook for savings in China.
Okay.
18 months ago when the market was soft, I think people were encouraged into the market. And I think the consequence of that encouragement was, and the consequence of the fact that the market had been very cheap 18 months ago, caused upward momentum that dragged a bunch of players into the market who believed that shares were sort of ticker symbols on a tote board rather than representing fractional ownership of businesses. I think there was a disconnect between the speculators' response. In other words, I think the speculators were participating in a market rather than understanding that they were owning fractional shares in businesses. And that disconnect almost always ends unhappily.
Right. So it's not so much a reflection to you of slowing growth there.
I think the collapse, the stock market decline in China was really a function of the fact that it moved too far too fast. It was a natural and normal correction, something we're very familiar with over years in the junior equities markets.
Right, absolutely. We can relate. Now, do you think that these stumbles affect the ability for the country to keep buying up gold? You mentioned that the government was encouraging people to invest as a form of savings, and we know they've been doing that with gold for a long time. So how do you see that being affected?
Well, if Vancouver real estate is any indication, there is plenty of private savings in China. And my suspicion is that with regards to the hot money in China, the speculative money in China, if gold begins to develop some momentum, you will see very strong retail buying indeed. The other thing, I think, is that there is also a different type of money in China. There is the more patient style of investor. I don't need to tell you, but gold has occupied a prominent place in the Chinese savings matrix and, in fact, the Chinese imagination for centuries. And there is very strong underlying demand for gold, not as a speculative vehicle, but rather as a store of wealth or a medium of exchange that has value in and of itself. And the indications that we get out of China is that, when I say we, I mean Sprott gets out of China, is that the underlying retail demand for gold in China is very strong, the fluctuations of their equity markets notwithstanding.
And what are some of those indicators that you mentioned that you're looking at to see how, commodity demands are being affected?
We're in contact with some of the distributors, both in Hong Kong and in mainland China, the retail distributors of gold. We do our best as sort of forward intelligence to stay in touch with lots of actors in the bullion and metals market on a global basis. We also manage some money for and in conjunction with Zijin Mining, which is the largest of the non-ferrous metals mining company in China. And it's useful to get the sort of policy feedback from Zijin in terms of what the desires and expectation of their largest shareholder, which is the government of China, feels with regard to gold. And it's been pretty bullish.
Now, what about other commodities and some of the indicators you're seeing in terms of relating back to the Chinese economy?
Well, certainly the very recent investment by Zijin into Ivanhoe Mines, an investment that could total in excess of $600 million, would suggest that the Chinese government's belief is that copper has a bright future and that utilization of copper in China would increase. There is no reason why a parastatal like Zijin would agree to invest $600 million in a politically challenged place like Congo if they didn't believe that copper had a very strong future. While the market has taken copper in U.S. dollar terms down from $3.25 to about $2.50, Zijin Mining has used the softness in copper as an excuse to buy into what is probably the best undeveloped copper deposit in the world, albeit in a politically challenged part of the world.
Absolutely. That is a very strong endorsement for copper, and a great time for them to be doing it. Now, the gold price has been, somewhat range-bound recently. What kind of gold price do you think we will need to see in order to sort of kickstart the junior sector?
We don't need an increased gold price to kickstart the junior sector. In fact, I'm not ducking the question, but I want to point out that if past is prologue, the last bottom that we had in gold in 2000 featured a gold price at sort of $260 US. And what was interesting about that market was that, like today, there was a gold bull market underway globally in all currencies except the US dollar. It's important to note that we have a global market in gold, and gold has performed in almost every currency with the exception of the US dollar as a function really of the US dollar strength. I think there are several conditions precedent for the gold and silver equities markets to increase. One is that we simply need to continue to eat through the excesses of the prior bull market. The bull market that we enjoyed, if that's the right word, from 2002 last year to really 2011 or 2012 this year, was of almost unprecedented duration. And the excesses in that market, the too many listings, too much general and administrative costs, stupid investment decisions, need to be, and I think they have largely been, worked through in the market. But you need to, there needs to be broad-based extinguishment of the zombies in the market. That 600 companies in Canada, as an example, that have a working capital deficit. If you look at all the general and administrative expense taken out of the market by companies that have no feasible reason to exist, you probably save $1 billion a year. And so I think the first condition precedent for the market is to absolve itself of the sins of the past, which I think we're in some way, shape, or form doing. The second thing is that there has been a real dearth of high-quality exploration taking place. There was a period where exploration seemed to be taking place to generate stock market returns as opposed to generate discoveries. I think there was too much drilling of, twinning of old holes and not enough exploration. The consequence of that is that we haven't had a lot of really exciting discoveries. And the exciting discoveries that we have had have been met with stock market approval. The third thing is, of course, the gold price. And the truth is, and I think this is really good news for everybody on the call, the market expectations for the gold price are so low. The interest in gold is so low that the challenge of the market will be to get under the bar, not over the bar. And any sort of sustained move in the gold price in the sort of $1,300 range, which is not very much to ask, I think would really surprise people. And bull markets start when expectations are exceeded. And the great news is that the expectations are so low that I don't suspect that exceeding them would be any particular challenge.
Absolutely. No, those are great points, all three of them. And I want to touch on high-quality exploration. Are you seeing any companies out there who, are making some exciting discoveries or might be close to that, bringing in more of some of that into the market?
Well, I think in northwestern BC, your panelists today can talk about the extraordinary discovery made by their neighbors, Pretium, and the potential that might have for their property. I think Reservoir Minerals has done a great job. I think in Australia, the Sirius Resources, although it was nickel, not a gold discovery, was interesting. There are 10 or 12 deposits that are working worldwide that we think are interesting. But if you compare that with prior market cycles, the 92 cycle in particular, there has been a dearth of high-quality grassroots exploration, and that's what this market is expected to do.
Right. Now, going back to later stage companies, have you seen costs declining at projects yet?
I think what we have really seen is that the cost increases have begun to be contained. That is, the worst of the excesses is are beginning to be worked out, and certainly we have a market that's finally paying some attention to efficiency. We're seeing a market that is beginning to accord stronger multiples to companies that have a culture of efficiency. Companies like Randgold, as an example. I think the other thing that we're starting to see is the beginnings of a realization, not by speculators so much, but by investors, that if you want to participate in a gold price increase, maybe what you do is buy gold as opposed to the gold stocks.
Right.
I think you buy gold stocks, as you alluded to, as a consequence of company-specific factors, things like increased production efficiency or increased exploration efficiency. The idea that you buy gold stocks as a way to participate in the up move in gold seems to me to be a little bit inefficient, particularly with the gold price so cheap. I think that investors, not speculators, but investors who believe in higher gold and silver prices are beginning to understand that they should buy gold and silver as opposed to the gold and silver stocks. And people who buy the stocks are looking for something extra, some alpha that's associated with factors specific to the company.
Right, and then therefore getting the leverage that could come from higher prices. Now let's talk a little bit about hedge funds. They've been burned trying to short Canadian banks and housing. How healthy do you think those sectors are?
I think the Canadian banking sector, and of course my boss is going to disagree with it, I think the Canadian banking sector relative to the American banking sector, at least the large American banks, is reasonably healthy. The thing that scares me, frankly, are Canadian real estate prices relative to Canadian incomes.
Right.
When I'm talking to you from Vancouver, and the prices of Vancouver real estate relative to the median incomes in Vancouver, there is a disconnect that's wilder than the disconnect that California was plagued with in the middle of the last decade. I don't know how that ends. I note, however, that the basic Canadian mortgage product, which is a 5-year mortgage, is a very banker-friendly product, and the Canadian banking sector, unlike the U.S. banking sector, is an oligopoly, something that, while it may not be healthy for the market, is certainly healthy for the banks. With the 5-year mortgage, of course, the credit risk and the interest rate risk is borne by the borrower more than the lender. In the U.S., the prevailing product is the 30-year fixed mortgage, where first the bank and then, of course, ultimately the taxpayer is on the hook both for the declining any credit risk associated with the borrower and also for the interest rate risk. So from the point of view of the Canadian banking system, the Canadian first mortgage product is a clearly superior product to the American product and lowers the structural risk in the banking system.
Right, and I definitely agree. I mean, being in Vancouver, we've seen most people really being priced out of the market and foreign investors coming in. You talked about American housing. Prices have been creeping up along with housing starts. Do you think the past is being repeated there?
I do. Well, it depends on what market you're in the United States, of course. There are pockets of real strength in the U.S. economy. I have the good fortune of living in one. But I think in the U.S., a lot of the increase in real estate prices, and for that matter, general securities, equities prices, have been driven by unrealistically low U.S. interest rates. We've chosen in the United States, and I guess around the world really, to transfer income from savers to spenders in the form of low interest rates. And I think that the low interest rates and low capitalization rates have been an important part of driving, in particular, American single-family real estate.
Right. Now, I want to get to a couple of viewer questions that we have. I have many more questions I could ask you, but I will save the rest of them for the upcoming Sprott show here in Vancouver in a couple of weeks. But we have some live questions, and Jim in Portland asks, please enlighten us about Greece and possible upcoming derivative problems.
Well, with the caveat that I'm really a credit analyst and not a political or economic analyst, I think that the economic impact of Greece will be fairly muted. At least it should be fairly muted. I think what it serves as, however, is a sort of a warning that you can't forever spend more than you save and expect other countries, investors, and taxpayers to fund it. Greece, as a percentage of the Eurozone GDP, I think is at about 3%. And so I think the actual impact of a 20 or 30% decline in the Greece economy on the economy of Europe will be fairly muted. Similarly, there was a proper fascist response in Europe with regards to the event of Greek default. By fascist response, I mean that the banks were very successful in offloading the ultimate liability for Greek debt onto the Eurozone taxpayers and off of their own balance sheets. So I don't think that a Greek default would harm in any particular way the private banking sector in Europe. It will just place an additional burden on productive people in Northern Europe who will be forced to bear the cost of the bailout on their private balance sheets as a consequence of tax liability. The bigger question, I suspect, is whether a Greek default or a Greek exit or a Greek collapse would affect the access to capital of peripheral players, be it Portugal or Ireland or places like that, or if the contagion that would come from the recognition that people are going to have a hard time paying back their bills would spread wider and impact credits in places like Turkey or Indonesia with large deficits, or even political jurisdictions closer to home like Chicago or the state of Illinois.
Right. Well, any kind of federation of unions, just like the United States is going to have, various issues like we've seen here in Detroit and just like you mentioned. The second question is from Dr. Huntsman, and he asks, when the money collapses, will seniors get some form of Social Security, perhaps a percentage?
The answer to that is I have no earthly idea. The vagaries of the voters and the legislatures have confused me for my entire 62 years on Earth, Vanessa. So I have no idea, and I would be cautious about using the phrase "when" with regards to that collapse. By the way, I went through the social and economic dislocations of the 70s, and it's interesting that despite the government's best intention to pull the citizenry down, the citizenry seemed to be almost infinitely inventive and productive, and I don't think there's any particular guarantee that we're going to experience a collapse. I do believe that there's going to be a reckoning, but it may not be as bad as some of the participants on this call might think it's going to be.
Right. Now our next question, I'm not sure who it's from, I don't see a name, but a simple rule of thumb that dictates the bottom of a gold bear cycle is a 50% retracement from the top. That would put us in the 950 plus or minus range, a price level that Jim Rogers has been consistently enunciating for 2 years. What does the panel think? Oh, from Walter.
Well, I'd be interested in the opinion of other panelists who are probably more attuned to technical analysis. There are a whole bunch of rules of thumb and ratios which people's minds gravitate to because they're simple, that I haven't found to be of very much use in my career. In terms of assuming that past is prologue specifically, I think that you ignore the fact that many things change around the world. I would prefer, and there probably isn't time in this call, I would prefer to think about gold not in the context of past gold market cycles, but rather in the context of competition from the U.S. 10-year Treasury, which I believe is the world's premier, for want of a better phrase, savings instrument. And my mind goes to credit analysis and fundamental analysis rather than to technical analysis, so I'm probably the wrong person to answer that question.
Right. Well, we can also ask other panel members as well, but I appreciate your answer. Vin asks, will Washington make gold coins illegal and take them from the public gold confiscation?
I think the U.S. government has more efficient ways to steal your wealth, the manipulation of interest rates being the classic example. I get asked all the time if I think that the government will confiscate gold or confiscate IRAs. I don't think they need to do that because they're already confiscating your savings by manipulating the interest rate down. And that's very efficient. Efficient enough that the majority of voters who are spenders rather than savers approve of that form of theft.
Right. I agree. There's different ways. Now, a question from Joe. Long-term holders of physical gold and silver, what circumstances or indicators would be a signal to sell some or all of one's position? For example, the gold-silver ratio.
Again, the gold-silver ratio doesn't make any particular sense to me. The 16-to-1 ratio deals with the prevalence of gold and silver in the Earth's crust, and I think it ignores fundamentals with regards to gold and silver, like industrial application and like competition from other investment instruments. I would suggest that if you got to a place where, as an example, private ownership of gold and silver related vehicles exceeded sort of 3 or 3.5% of total investable assets in the United States, up from about 1/3 of 1%, then you would be in a circumstance where gold and silver were looked at favorably enough that one would want to begin to exit the speculative part of one's holdings. Until, I think, and I'm talking to Americans now rather than Canadians, until we have a clear-cut way to deal with $18 trillion in on-balance sheet obligations and $100 trillion in off-balance sheet obligations, I think that prudent people will continue to be long-term holders of gold because it's a financial asset and a medium of exchange that isn't simultaneously somebody else's liability. And most of the financial assets that savers have been taught to hold, the U.S. 10-year Treasury being a classic example, are merely mediums of exchange. They don't feel to me, well, they're certainly somebody else's liability. And as we have seen with Greece, sometimes people choose not to honor the liabilities, or at least to inflate the obligation away.
Right. Now we have our next question is, Rick, what are you most tempted to short these days? Are you actively shorting anything?
These days, I only short businesses I understand, and the resource sector is so out of favor that I haven't found much to short. I have, from time to time, shorted fairly obvious frauds on the Toronto Stock Exchange, on the TSX-V. But the truth is that the sector that I'm involved in is so out of favor that none of the frauds seem to be working. So there isn't very much to short. I suppose were I more knowledgeable in this sector, I would be short some of the very small technology stocks. And I suspect I would be short a bunch of the marijuana stocks, despite the fact that it's interesting to see in the small cap market officers and directors engaging in an activity that they know something about. I still would be tempted as a consequence of the plethora of marijuana stocks to be shorting them, but I'm embarrassed to say, perhaps it's a function of my age, that I don't know very much about that industry.
Right. What do you think of tech valuations right now?
Well, I'm always concerned about capitalizations in the $400 or $500 million range absent revenues. I was concerned about that in the gold and silver business at the end of the last decade. And so certainly technology companies that have no revenues and no particular prospect of revenues concern me. Having said that, I can understand with regards to mining companies the road to revenues, and I'm a reasonably good analyst, and so I can assess the probability that those valuations are rooted in reality at some point in time. With regards to the small technology stocks, and, one consequence of living in California is that you're exposed to this all the time. My difficulty is it's difficult for me to analyze a business that I can't even pronounce. And so I avoid the technology stocks like the plague. It's easier for me to understand commodity cycles and more simple businesses like extractive industries relative to businesses put together by a sort of coalition of very young, smart, pimply-faced kids in a garage that changes the world.
Yes, a Vancouver company was bought this morning for $535 million called Plenty of Fish, which is a dating website that was started in a Vancouver apartment. Not a garage or basement, an apartment, but
dating fish doesn't sound like a particularly attractive proposition to me.
well, it sounds like you have a very similar vein of thinking to Warren Buffett, and I don't think he's changed his approach to tech stocks either.
Anytime you feel like comparing me to Warren Buffett, please do so.
Great. Now, Mark asks, when will Wall Street come back or start to get into gold?
I don't have an answer to that. I think there's amazing confidence in the world today, and I think some of the confidence with regards in particular to the U.S. 10-year Treasury needs to be shaken. I don't, by the way, think that gold will win the war against the U.S. dollar, but I do think it'll lose the war less badly. In terms of pinning me down to a time and a date, which is, of course, what your caller would like to do, I'm too old and wise for that. I think it's inevitable, but I'm not sure it's imminent.
Right, we'll see Main Street coming back or rushing into the sector at some point. Now, Ian asks, you've expressed doubt that the Fed will raise interest rates, but Yellen has been making stronger indications that she plans to. How do you think a rate rise will play out?
I don't know. I truly don't. I don't know if Ms. Yellen has the political room to do it. I would love to see her do it. I would love to see the disconnect between savings and the reward for savings measured and honored in society. I suspect at some point in time, if we begin to have some doubt about the stewardship of the economy, that the market would raise interest rates with or without Ms. Yellen. The hegemony of the political class over the economy is a fairly recent aberration, and I think it's one that's really born of confidence, confidence which I believe is misplaced and confidence which I think will recede. But I have to admit that I'm amazed that they've been able to push the economy as far, or at least push markets as far as they've been able to. You know, further to this question, I remember the narrative in 2008, 2009, which was in the U.S. with on-balance sheet liabilities at $14 trillion and off-balance sheet liabilities at $65 trillion, that the U.S. debt was simply unserviceable. And now people are sanguine about the serviceability of that debt with $18 trillion in on-balance sheet liabilities. What is it about $4 trillion in new liabilities that made the debt somewhat more serviceable? It reminds me in a different quantum with the fact that everybody understood that Greece couldn't service debt at 135% of GDP, so they took it to 175% of GDP with obvious results. If that sort of arithmetic begins to get in the public consciousness, then I think that the interest rates will raise themselves.
Now, do you ever think we could see similar capital controls that we saw recently in Greece?
I see it if it occurred much farther out, but I certainly wouldn't put that past them. You know, under the guise of tax fairness or something like that. I think that's a much stronger possibility personally, although I'm not a political analyst, than things like the government nationalizing IRAs or nationalizing gold. The institution of currency controls is something that I think that they could explain away much more easily. And it would, of course, mostly affect the rich, the productive, which are a vilified class in America.
Right. Now, do you think that with European markets and with U.S. markets that they'll start to be anchored again at some point on fundamentals rather than politics, as we've seen more recently?
Ultimately, I think markets always work, but I think the transition could be very messy. I think there's an undercurrent of investors in the United States and around the world who are still fundamentally centric rather than momentum or interest rate centric. But certainly the momentum players in the institutions have the upper hand right now. I don't know how that will end, but I suspect it'll be messy.
Right. Now we have a question now from Chris. Do you like silver at this price as well, or is it too tied as a commodity, unlike gold as money?
I'm a bit of a gold bug. I believe that we are going to have a pretty nice gold market, and my experience in the last 4 market cycles has been that gold moves first, but silver moves furthest. The investor in me owns physical gold. The speculator in me loves the silver market. So I must admit, although I don't hold very much physical silver myself, I have a reasonable position in the Sprott Physical Silver Trust, the PHYS, the Sprott Physical Silver Trust on the New York Stock Exchange. I've chosen in in my declining years to sort of simplify my life and not take physical delivery of the stuff and march it down to a bank vault. I prefer to own certificated gold and silver and platinum and palladium, and of course I prefer to hold them in the Sprott products because I obviously know and love the Sprott management team.
Right. It sounds like a great strategy. Now, you've said before that the American people have confused stock market gains with the health of the overall economy. Is that because of the buybacks that we've seen and the amount of debt that companies have gone into?
I think that's partially true, Vanessa. I think in a very much more general sense that the psychology involves the fact that people's expectation of the future is set by their experience in the immediate past. And their immediate past with regards to financial markets has been pretty good. I think the second psychological factor is that it is more pleasant to not be worried than it is to be worried. And coming through the 2008 crisis, I think people looked into the abyss and were very nervous about what they saw. And they were very relieved that they didn't go there. And I think that most of the country, not the people in this call, but most of the country believe that the big thinkers of the world, the Obamas and the Yellens and the Carneys and the Merkels and all those people, stick-handled in Canadian parlance the economy fairly well. So I think there's a bias on behalf of people that they want to believe that the big thinkers of the world are responsible for their financial future and are doing a good job. And there's the ability to do that as a consequence of the fact that people's experience in the immediate past has been pretty good. And it's much more pleasant to think that the economy is being well handled than it is to think that the economy is being poorly handled and that people must take control of their own financial future.
Right. I would tend to agree. I have one last question for you, and then I want to touch a little bit on the Sprott show coming up. Do you think that you've seen some fundamental changes in the junior markets with this downturn, and that certain things will never be the same?
We're just beginning to. There are a lot of things that have had to change, but mostly investor attitudes have had to change. We were too tolerant and too permissive in this market, and one of the things that's happening is companies are just now starting to go broke. But more importantly, voluntarily or involuntarily, companies are amalgamating. We need much less G&A, general administrative expense, relative to assets under management. And superior investment products need to clear inferior investment products out of the market. You're starting to see 2- and 3-way mergers. As an example, maybe this is a commercial, but the very recent tender by Sprott for the Central Gold Trust and the Silver Bullion Trust in the United States is our own attempt to have a better product move a weaker product out of the market. And the acceptance that we have got in the short time that we've had that tender live from the big institutional investors in those competing products tells me that the market is ready for more efficient participants to crowd out less efficient participants. The fact that we're able to, we think, be successful with what's nearly $1 billion tender distributed over thousands of retail hands tells me that the market is ready for more efficient participants to crowd less efficient participants out of the market. And I think it's something that we really need to see for the health of the market.
Mm-hmm. Now, just one last question here from a viewer. Matt asks, should Americans store some assets overseas, and how about a second citizenship?
I think that really is something that people need to consult with their own advisors on. I wouldn't hold myself out to be somebody capable of doing that. I myself have chosen to hold the vast bulk of my gold and silver in the Sprott products on the New York Stock Exchange. Mm-hmm. But it's important to note that I think the essence of wealth is a sense of well-being, and if a second passport, which I do have, or bullion holdings outside of the domicile that you live in enhances your sense of well-being, I think it's very, very worth doing.
Right. Absolutely, and may help you sleep better at night, or
which is the essence of wealth.
Right. Quality of life.
Yeah, it isn't just a number.
Mm-hmm. And with regards to that, what keeps you up at night these days?
What keeps me up at night is arithmetic. It is the unsustainability of debt. It is the prospect of the pendulum swinging back the other way. The 70s, the social unrest in the United States had a sort of a profound impact on me. I'm delighted that we got through it, and I would prefer not to revisit it again in my life. Mm-hmm. And my hope is that I have the ability. Well, my hope is, first of all, it doesn't occur. But mm-hmm. my second hope is that to the extent that it does occur, that as Doug Casey famously says, I can watch it from somewhere else on a broad screen TV, joined by my friends and family.
Right. Now, we really appreciate your time this morning with answering all these questions. You've been very generous. I want to talk just a little bit about the Sprott show that you have coming up. It's the second annual Sprott show. What would you say to investors who would ask the question if conferences are still relevant today?
I didn't hear the question. I'm sorry, Vanessa.
Oh, sorry, Rick. I was asking if you believe conferences are still relevant.
Oh, absolutely. The success of this conference over time proves it. This is the second year that Sprott has run it, but Agora ran it for 18 years before that.
Right.
And the direction of this conference has been shaped, at least under Sprott stewardship, from attendee evaluation forms. In other words, every change that we have adopted has come about as a consequence of attendees telling us what they want to do. Despite the fact that the resource market has been in the doldrums, attendance was up last year by 30% from the year before, and this year by 20% from last year, which will tell you something about the value that attendees believe that they get from the conference. Conferences are extraordinarily useful for speculators. You have to outcompete other people in the market. And coming to a conference to hear what editors and analysts have to say, what company executives have to say, importantly, coming to hear what the exhibitors have to say, having the ability to meet one-on-one with company CEOs. And by the way, mixing and mingling and hearing from other attendees is useful. We'll have in excess of 500 attendees at this conference. And the idea that all of the knowledge in the room emanates from the dais and goes down into the room when you have 500 wealthy investors in the room is silly. There's all sorts of knowledge that is available in the room to talk to. I think another question might be this conference relative to other conferences. And I think there's two things that make this conference stand out. One, attendees last year asked us to have on the podium more speakers who ran mining companies, but they asked something very specific. They wanted us to have speakers who had built companies that they still ran. And they wanted us to have those speakers address how those companies were built and what lessons existed for speculators in choosing management teams who had the capability of turning small companies into big companies. And we've done just that. The second thing that attendees have told us is that from their point of view, exhibitors are content. They aren't advertisers. And the consequence of that is that the mining and oil and gas companies that exhibit at the Sprott conference are mining and oil and gas companies that are owned by Sprott in managed accounts. That doesn't guarantee that they're all going to work, but it guarantees that we know enough about the companies that we have invested money entrusted to us in them. In other words, there has been a certain level of scrutiny and due diligence. And the attendees have asked us to consider just that. The attendees have said, we believe that the exhibitors are content, not just advertisers. And so we have turned down literally dozens of companies that wanted to participate in this conference because we didn't know enough about them to invest in them ourselves.
Right, so they're qualified and
doesn't mean they're all going to work, Vanessa. You know the way markets work, but it does mean that we have studied them enough that we have been willing to own them.
Well, it definitely sounds like a very valuable event, and we'll definitely be there ourselves as we were last year. It was a great conference, a great event, and you can go to, there's a registration link that we just posted in the chat if you'd like to learn more about the symposium, and we look forward to seeing you there. Thank you so much for being so generous with your time this morning.
Thanks for the opportunity, Vanessa. I always enjoy it, and I look forward to seeing you at the conference.
Okay, great. We'll see you there.
All right.
Now, next up on the call, we have Rudi Fronk. He is joining us this morning, and we will just be loading him onto the call here. You can send your questions in through the chat window as well for Rudi, and we'll try to answer as many questions as possible. Rudi's going to be at the Sprott Symposium coming up in a couple of weeks here, presenting, as is Jonathan Awde with Gold Standard Ventures. So it'll be great to hear from them and get an update on their companies here. Okay, well, our next guest joining us on the webinar this morning is Rudi Fronk, and we're very pleased to have Rudi joining us again today on another special event. He is the chairman and CEO of Seabridge Gold. It's great to have you here, Rudi.
Vanessa, great to be back, and thank you for the opportunity.
Absolutely. Now, Rudi, I know that you've just sort of kicked off your summer drilling program with some core drilling that's begun at your 100% owned KSM project in northwestern BC. Now, what do you have planned for this summer's exploration season?
We hope to continue on the success that we've had over the past 2 years, and that's to explore for higher grade material. With the recent addition of Deep Kerr and the lower iron cap zone, over the past 2 years, we've now added over 11 million ounces of gold resources and 10 billion pounds of copper at grades that are 50 to 100% higher than the reserves and the resources that lie above these new zones. Our program this year is designed to continue to expand Deep Kerr, lower iron cap, and for the first time to test for a higher grade feeder zone underneath a large Mitchell deposit.
Right. Well, some of these recent discoveries that you've had of other core zones, how would you say they've changed the project overall?
Well, I think there's been two benefits from the discoveries. First is that as a result of higher grades, we're going to be able to change the mine sequencing of this 55-year mine plan, moving some of this higher grade material towards the front end of the mine life. And this obviously will help improve the project's economics. But probably more importantly is that Deep Kerr comes with it with a lot of copper. Up until recently, KSM was really viewed as a gold-dominated project. Deep Kerr has copper grades that are higher than some of the most successful large porphyry mines in the world today. And as a result, we now have some of the largest base metal miners looking at KSM for the first time.
Right, and that's really, I mean, your story's really shifted from a gold story to more of a copper gold story. And I know that part of that means that you're looking more at block cave mining. Can you talk a little bit about block cave mining and break it down for our audience?
Yeah, block cave mining really is the mining method of the future. As I go around to mining schools and give talks, I really try to make the point that block caving is a curriculum that needs to be included at the successful mining school. Block caving technology over the years has resulted in tremendous low operating costs for underground mining. You can see block caves around the world today that can successfully be mined through development and mining costs of less than $10 per ton without having the environmental disadvantages of having to mine large quantities of waste above it and store it. So I think block caving is the method of the future. Most of the big mining companies in the world today are significantly trying to advance block caving technology with their own organizations. And we're fortunate that KSM, both of the new deposits, Lower Iron Cap and Deep Kerr, can be mined very efficiently as underground block caves.
Right, and now has this significantly changed your strategy in terms of looking for potential partners?
Well, it has in that block caving technology will be important. Most of that capability is now with the big base metal companies. So having the big base metal companies now reviewing the project for a joint venture possibility is a big plus.
Right. Have you are you close to signing or kind of determining which partner you'll choose to work with?
That's an ongoing process, Vanessa. What I can say is that as a result of the environmental assessment approval plus the additions of Deep Kerr, we've never seen the interest level that we're now seeing for potential joint venture partners. We now have more than 10 of the largest mining companies in the world under CA looking at this opportunity.
Wow. Well, that's very exciting. Now, once you select or secure your ideal project partner, what kind of time frame would you be looking at for construction and commissioning of the mine?
We are fortunate in that in addition to the environmental assessment, we also concurrently applied for the early stage construction permits that will be needed to start building this mine. We now already have in hand permits for the first 50-plus constructions items that will need to go forward. This project is now shovel-ready. Any partner can come in and start building roads, building tunnels, building camps right now. Those are already in hand. I think the timing will really be a result of determined by the partner we bring in when they would like to start those activities. Once those activities begin, it's probably 4 to 5 years to first production.
Okay, so you're looking at 4 to 5 years from now. Now, at this stage, you just raised about $16.4 million in April. I'm curious if you found it challenging to raise money in this environment.
Actually, not at all. My years of experience in the business has taught me that if you have a good business plan with good assets, you should be able to raise money in any market environment. And our recent success of being able to raise the $16 million in a flow through at a 27% premium to market just reinforces that. In fact, it's interesting to note that the premium we did receive in the recent financing is the largest premium that's been paid in the industry over the past year.
Oh, wow. Yeah, that's quite remarkable. Now, just in terms of the next steps, are there any other steps in addition to the environmental permit that you need to complete in order to de-risk the project anymore?
Well, I think we've done a lot over the past 8 years through engineering, exploration, and the environmental assessments. I think that now the challenge is to find the partner that will build this mine. This is a huge project that's going to require a lot of capital, and as a result, in the current market environment, it's been difficult.
Right. It's definitely been difficult, but as we've observed, and you and I have talked about before, it's been a great time to build value as well. And in addition to the drilling that you're doing, what else will this capital do for the company?
Well, we've also committed to update the pre-feasibility study that was completed in 2012.
Okay.
That study shows a very capital-efficient project, a project that can produce metal all-in cost for less than $800 per ounce of gold produced.
Mm-hmm.
The higher-grade zones have not yet been factored into the study. The updated study that we're planning to complete will start to look at what will be the impact of these higher-grade zones on the project's overall economics.
And how long do you think it will be until we see the results of that?
We expect to have that study done at the end of the first quarter of 2016. We would like to have the benefit of this year's drilling results to incorporate into that updated study. The other nice thing about that updated study is there's no question that metal prices have changed over the past several years, actually have gone down.
Right.
Offsetting that, however, is a weaker Canadian dollar, which is positive for the economics of KSM, much lower oil and steel prices, which will help bring the overall upfront capital down, and also a much more favorable Canadian labor market. Back then, we were challenged with the oil sands market in terms of what the cost of labor was for these types of projects. That has lessened considerably in the past year or so. So we're going to see a much lower labor component in terms of dollars per hour for the construction component of the project.
Right. Well, we'll certainly be watching with interest, all the developments that you have ahead of you. I just wanted to ask as well, just overall looking at the space, what do you see happening with M&A in the mining space these days?
Well, obviously, the last few years have been very difficult for all metal companies, especially for those that have large projects of large capital requirements. I believe that right now in the current environment, still a buyer's market. Is very reminiscent of the period from 1999 to 2002 when we started Seabridge and looked to buy advanced stage gold projects in North America. I believe that Rick Rule is correct in an assessment that we will see hundreds of companies dying on the vine in the current environment just due to lack of funding.
Right.
A good washout at the bottom is not a bad thing. It actually it just brings forward companies like Seabridge that have real assets.
Right.
However, rest assured that when the market does turn, which obviously we believe it will, we'll once again see the larger companies on the prowl and they'll need to fill their pipelines that are now glaringly empty.
So do you think it'll take, sort of this separating the wheat from the chaff, as Rick puts it, some of these delistings and these companies dying off before we see that M&A happening?
Yeah, I think, although you're starting to see some of it now filling specific voids like Newmont's recent acquisition of Cripple Creek. And I think for the most part, to really see the big projects with a fire lit under them again, we'll need higher metal prices and higher share prices for the acquiring companies.
So for you, it's more higher metal prices, you think, and share prices that will need to take place in order for some of the bigger acquisitions to happen?
Yeah, I believe so. Which is why we're not looking to be acquired. We're looking to do a joint venture. Share price doesn't factor in that much in terms of joint venture discussions. My experience is that what really creates a successful joint venture process is competitive tension. And now having more than 10 of the largest mining companies in the world, both on the gold side and the base metal side, I believe for the first time we do have that competitive environment that will bring forward a successful joint venture conclusion, regardless of what metal prices do. Higher metal prices would help, but they're not necessary for us to complete our joint venture transaction.
Right. Well, we have some investor questions coming in from our viewers live here, and the first one is from Jim, and he asks, according to Canadian Insider, Seabridge has seen significant buying by FCMI Financial. Can you shed some light on their interest in Seabridge?
Yeah, FCMI and Albert Friedberg, who controls FCMI, has been a shareholder in Seabridge since 2001, one of our earlier big shareholders that came in. Over the years, he increased his position that entering into 2014, he owned 19.5% of the company. He wanted to own more Seabridge, but he didn't want to go through that 20% threshold, which puts handcuffs on you in terms of your ability to buy or sell additional shares. So he was able to work out with the regulators a structure whereby he sold half of his position in Seabridge to National Bank of Canada, and then he immediately entered into a swap arrangement for those shares, where he now has all of the financial interest in those shares, but no longer voting control. The 20% threshold is triggered by voting control. This allowed Mr. Freeberg and FCMI to go out and acquire additional shares in the market. Since he completed that swap in June of 2014, he's now bought almost 2.5 million shares, another 5% of the company in the market. He continues to buy shares on a very regular basis. We love shareholders like Albert Freeberg. I don't know where we would be without him at our side.
Absolutely. Well, thank you for that. Our next question is from Louis R. He says, so few CEOs take the time to speak to the gold and silver community of shareholders, so I thank you, Rudi. One, in your opinion, what news is around our metal stocks? So I guess why are metal stocks being so heavily discounted at the moment?
Well, I think the answer is quite easy on that, is that the Western investor has given up on gold because they believe that the central bankers around the world know what they're doing and there's no reason to own gold anymore. We think that over time that will play out very differently than what the mass investors believe is happening today. Matter of fact, as the individual pointed out, we do write very, very regularly on the gold market on our website. If you actually go to our website and pull down the investor tab and click on the case for gold, you'll see our recent articles, which we call gold market flashes, that talk about gold from the macro perspective in terms of why we remain bullish going forward.
Right, and I believe GoldSeek also publishes those flash notes as well, which you can find on GoldSeek as well. Second question from Louis is, what chance, if any, do we have in recouping some of these losses in the near future?
Well, that's a great question. I know as I look at my portfolio, since most of it's in Seabridge shares, it hasn't been a good couple of years. I'm asking the same question. But what I will tell you is that we know that the most important thing that we can do for our shareholders is to complete a joint venture with the right partner under the right terms, and that is our goal. I think that will be a binary event for the company when we do have that endorsement from one of the biggest mining companies in the world moving forward on KSM. We're going to see that play out in spades in terms of our share price. The best comparable company to Seabridge is Noble Gold, that has two large undeveloped projects in similar jurisdictions as KSM and Courageous Lake. But because they have the sponsorship of Teck Cominco and Barrick Gold as joint venture partners, they traded valuations that are many multiples of the valuation we received. I believe that with the joint venture successfully in hand, that we will see a significant re-rating in our shares, and as a result, obviously, much higher share prices.
Excellent. Our next question here is from Norman. If I am correct, each share of Seabridge Gold holds about 1 ounce of gold in the ground. Why is the share price so ridiculously low?
Similar answer to the last question. You're right, it is ridiculously low. That's just the market we're in right now. Mm-hmm. I mean, you know, if you look back several years, in 2007, when we made the first discovery of the Mitchell deposit and quantified the resources, our shares were trading towards $40 a share, and now they're down below $6 in the U.S. markets, not counting all the success we've had in terms of additional engineering, exploration results, and a fully approved project now at KSM. I believe that as the market does turn, obviously, Seabridge, because of the gold content per common share, anytime the gold market gets strong and gold equities start to move, Seabridge outperforms the other gold stocks by multiples, and I don't think that'll be any different this time as gold breaks out of this 4-year bear market, starts to move to prices that people won't believe how high it will go.
Right. Well, thank you so much for those answers for some of our viewers here. And Rudi, if viewers want to catch up with you, you're going to be at the Sprott Natural Resource Symposium coming up here at the Fairmont Hotel, Vancouver, July 28th to the 31st. Is that correct?
That is correct.
What's your intention at the show and for attending it? I believe it's your first year exhibiting at the conference.
Well, that's easy. Actually, being in front of an audience that will appreciate a company like Seabridge.
Right.
I think, Sprott, obviously, I've known Eric for many, many years. Rick Rule is now part of them. Whitney George, who joined them from Royce. Trey Wright, who's now their new gold expert. This is a great organization that will bring in accredited investors to look at the names that we're presenting there. And I think that we have a very interesting story to tell, and I look forward to telling it to perhaps a new group of both retail and institutional investors.
Absolutely. Great. We'll look forward to seeing you there as well. Rudi, GoldSeek will be in attendance, and thank you so much for joining us this morning on the webinar. It was great to have you, and we wish you luck in establishing and identifying your joint venture partner in the next while here.
As always, my pleasure, Vanessa, and we'll see you in a couple of weeks in Vancouver.
Okay. Bye for now.
Great. Well, it was wonderful having Rudi with us this morning. I'm very pleased that our next guest is Jonathan Awde, the President and CEO of Gold Standard Ventures, which is on the NYSE market as GSV, TSX-V, GSX. John, a very warm welcome to you this morning. Thank you for joining us.
Thanks very much. It's a pleasure to be here.
Now, John, with Gold Standard, you've assembled a sizable contiguous land package in Nevada. Can you tell us what you've got there and how you're prioritizing exploration?
Sure. Over the last 4 years, we've used this downturn in the market to finish our consolidation of the entire southern portion of the Carlin Trend. Basically, everything south of Newmont's Rain District, we were able to consolidate, acquire through either staking, acquiring additional leases, or outright acquisitions. The original land package that we acquired back in 2009 as a private company was about 13 square miles, and we've now grown that to roughly 48 square miles, which is the second largest contiguous land package in the Carlin behind Newmont.
That's quite the sizable package. And just before we talk about what you've got planned for this year's drilling program, I just want to touch on the Oceana Gold deal. How did that come about for you?
Well, we work quite closely with Macquarie Capital Markets in both Vancouver and Toronto, and they have a very good relationship with Oceana, and they introduced us to Oceana. Oceana went down to site in Q1, and then there was several months of due diligence and back and forth, and we were able to come to terms on a deal that we felt was in the best interest of our company and our shareholders, which allowed us to essentially be fully funded to carry out our exploration program and to ride out this downturn, however long this takes to wash itself out. We'd be one of the companies that has cash and at least can get some work done, capitalizing on lower costs, lower drilling costs. Everything is a lot cheaper to get done, but it's the hardest thing to fund.
Right. Now, having that on hand, how long will it last you?
We've got about $17.2 million in cash, and really we can tailor. We have a lot of flexibility in our exploration and in the programs that we're running. So what's been approved by our board is an additional $2 million for the rest of the year, and that's largely going to be spent on our Pinion and Dark Star deposits, which are shallow oxide targets that we think will be very, very similar to what's going on to the north of us at Emigrant. A shallow oxide heap leach, run a mine, something that makes money at these gold prices. So we do have other targets that we'd like to drill. The relationship with Oceana is very good, and they're very supportive of us exploring other targets, but also recognize that it's important right now that we focus the bulk of our efforts on Pinion.
Right, and so is that what you have planned for this year's drill program?
Yes, most of that $2 million is going to go into exploring Pinion and Dark Star. Both, a combination of small step outs to expand the resource, but there's also a lot of really exciting targets that have been worked on over the last year that have come about because we were able to consolidate this whole district and really be the first company to put this whole land package together. We ran a really interesting soil program a few months ago that's yielded some great results, and we're really building up the targets in the Pinion Dark Star district. But Pinion Dark Star, it's something that's shallow, heap leach, potentially run a mine, something that we can put economics around quite quickly. We can drill this target with RC. Quick turnaround time, so it's easier for us to add ounces at a target like Pinion and Dark Star, and it's a far more cost-effective way to do so in the current gold market that we're in.
Right, and now you mentioned some other targets. Are you just going to be focusing on Pinion and Dark Star then, or?
At this time, we are going to focus on Pinion and Dark Star. However, we are building up other targets in the district because it is a large contiguous land package. It's a target-rich environment, but it's important for us to focus because of the market that we're in. We have other targets that at some point, if we do get a better market, we'd like to get back into. And, I think that we're going to be able to get our drilling done a lot cheaper than we have been in the past. I mean, that was arguably, the Achilles heel for us drilling our North Bullion target 3 years ago was just the cost associated with drilling these holes, the time component. Our core costs have come down dramatically. So at some point, we would like to put a resource around North Bullion. It's by no means closed off. It's just a function of how do you finance and sustain, paying for holes that take a month to drill, and you have to drill the core.
Right, so you're not sure when you might do more drilling at North Bullion.
Yeah, North Bullion is a target we can drill year-round, and we had the last holes that we announced from North Bullion were in January of 2014, and we think that we really opened up a major new direction for North Bullion. But again, it's a target we can drill year-round. We'd like to get our work done at Pinion and Dark Star, and potentially bring along some of the other targets that have drill holes into them that need to be followed up, and utilize this RC rig as much as we can to expand on the shallow oxide targets that you can much easier put economics around.
Right, absolutely. Now, just to touch on the railroad project, you've seen some spectacular drill results there. In the past, do you expect to see more of those long, rich holes in the future?
Well, look, I mean, the Carlin Trend is home to some of the largest, highest grade deposits, in the world. And, when we discovered North Bullion back in 2011, it was a blind discovery. And, we strongly feel that North Bullion will not be the only discovery of its kind on the project. And that's why it's important for us to do other, moderate exploration to test some of these other targets. And that's really one of the things that Oceana got behind and really supportive of us doing is because they feel it's a target-rich environment. It's a very large district. So absolutely, we have other targets that we think are very big, targets indicative of what you see in the northern end of the Carlin. So certainly we do strongly feel that there are more of those intercepts out there.
Right. Now, you put out maiden resources on both Pinion and Dark Star. How have these changed the nature of the project?
Well, when we acquired Pinion back in March of 2014, we viewed Pinion as being, growing, evolving into a similar target as Emigrant, which is a producing mine in the Rain District that one of our former geologists was a big part of discovering. So when we came out with our maiden resource in September, which was 1.45 million ounces of gold, we still felt it was open and we were just getting started. And we came out with a maiden resource for Dark Star in February of this year. So collectively, we're at about 1.85 million ounces of gold and growing. That does not include 44 holes we drilled in phase 2, and we are going to update both the resource at Dark Star and Pinion to reflect the phase 2 and phase 3 drilling at some point in September. And we do feel that we're going to be able to add to the mineral inventory. And now we view Pinion in a different light because we are now sort of past what we thought originally it could be. We just see a strong system and with an opportunity to expand it.
Right. Now, are you at all worried about the grades of the deposits? Do you see the grades going up?
No, not at all. The head grade at Emigrant is 0.52 grams per ton. Last year, the Emigrant mine was Newmont's most profitable open pit mine in the state in terms of the cost per ounce. So depending on what cutoff grade we use, we could have about 100,000 less ounces in our resource using a 0.3 or a 0.4 cutoff. So our grade right now in our resource, using the same cutoff that Newmont used at Emigrant, is about 20 to 25% higher than the grade at Emigrant. And going to a 0.3 or 0.4 cutoff, as some of the mining analysts who cover us use, again, you lose less than 100,000 ounces, but you're closer to a 0.72 grams per ton. So no, I'm not. We're not concerned with the grade at Pinion.
Absolutely. Now, what kind of mine are you looking at the project now?
Well, again, we're going to look to put some economics around the deposit towards the end of this year, into early Q1 of 2016. One of the things that we're looking at doing right now, and just actually doing some of the work, is our metallurgy. As you all know, a heap leach mine is the economics of a heap leach mine are most sensitive to recovery, and the recovery at Emigrant is roughly 70%. So we feel that very similar geology, very similar rock type, and we strongly feel that our recovery will be in that ballpark. And the economics associated with a recovery in that ballpark are very good, even in this gold market. So we're looking at a heap leach operation where a portion or the majority of it could be run of mine.
Right. Okay. And that's in order to keep your costs lower.
Yes. And a run of mine heap leach operation would be amongst the lowest cost producers in the industry. And I think that we certainly feel that Pinion has a chance to improve the metallurgy and to essentially de-risk the asset, again, given the context of the current market environment.
Absolutely. Now, so early Q1 2016 is when you're going to be moving towards mine planning?
Well, that's when we're going to have our PEA out, and depending on what the final metallurgy looks like, and where the gold market is then, if the metallurgy is where we think it can be, you're probably gonna move towards a positive decision to continue to put this thing into production.
Absolutely. Now, what kind of a development timeline and exploration goals do you have? I know you mentioned a little bit, it kind of depends on the market, but I'm sure you have some internal plans on your long-term strategy.
Yeah, look, I think that, we have an oxide asset that in Pinion and Dark Star that we'd like to keep growing and advancing, put some economics around it. Obviously, we're getting the metallurgy done, and again, having a balanced approach with doing a small amount of exploration, utilizing lower drilling costs to advance some of the other targets along. We're doing a lot of our baseline environmental studies that need to get done for the permitting side of it. Some of the multi-year studies, we're well along into. And just to put things into context, I mean, the last two heap leach assets that were permitted in the state of Nevada, both of them took less than 2 years to get their permits, and that was the Pan project that belongs to Midway, and Newmont's Emigrant mine.
Right. That's fantastic. Great timeline and turnaround on permitting there for sure. And Nevada's always been such an excellent state for mining. Do you have any plans in the future to diversify to any other jurisdictions?
Look, I think with where we are, with the company, the management team, the exploration team that is largely a Nevada-based exploration team with a number of discoveries that are now in production, in Nevada. I think that's where our strengths are, and that's where our niche is, and our ability to get very good, systematic work done that historically has led to discovery and adding ounces. So no, I don't think we would venture outside of the state. I mean, obviously with the current status, current state of the market, there's a lot of assets, there's a lot of opportunities out there. But again, it's really important for us to be focused, given how challenging the market is. But look, this is the kind of market, as Rudi said in the last talk there, which I absolutely agree with. We're somewhere at or near some kind of a bottom here, and this is where you can get assets, you can consolidate, you can acquire things without paying through the roof. Right.
That's very true. Now, John, we're getting a lot of viewer questions coming through, so I have a few that I'll present to you here. We have from Nick. I'm an investor in GSV. I would like to ask when you think Nevada will start to see a premium as a safe mining jurisdiction versus the growing risks in other parts of the world.
Very good question. Look, I think that just given how challenging the market is, I don't think that many places in the world will garner a premium. Parts of Canada, Quebec, Ontario, British Columbia, where you have the advantage of a weaker Canadian dollar, I think you're going to see a gravitation towards places like that. Parts of the U.S., Nevada, Alaska, are fantastic jurisdictions to be drilling, developing, producing. I think in terms of getting a premium back towards some of these places, I think you need to see a change in sentiment and a change in you need to see some kind of money flows into the gold space by generalists, and you're starting to see dribbles of that, but you're not seeing it in scale where that money will flow to the right jurisdictions, good jurisdictions, because it's tough enough to navigate this market, let alone take on political risk. People just aren't willing to do that.
Okay. Our next question is from Josh. When would a potential suitor, like a major gold miner, such as Newmont, be interested in buying a JV in your projects? They seem to be mining through all of their gold reserves.
Yeah, I mean, that's a great question. I mean, you look at the depletion just in the state of Nevada alone, there's between 5.5 and 6 million ounces of gold that was mined in the state of Nevada last year. And that's, in large part not being replaced. I think at this time, Gold Standard is not pursuing a joint venture. We've had several discussions. We've been approached several times about that, but I think that there is more value in for our shareholders, more value creation going on the current path that we're going on, and particularly now that we're funded. I think we can be one of the explorers / developers that can, when this market does turn, will receive potential premium, given our location, given our land package, and given the fact that we have a shallow oxide target that we're looking to put some economics around. So yeah, look, Newmont has, they've obviously, they have to keep the exploration and the development and production going in Nevada, as does Barrick. And I think they certainly have to keep that pipeline going.
Right, great answer. Now we have from Steve, how are you able to raise money now when most junior companies are exploring for capital and just surviving? If you can raise money, would it make sense to buy up struggling companies?
Well, look, again, similar to Rudi's answer in the previous presentation, which I thought was spot on. Yeah, the environment to raise capital is very, very challenging, and I think that good people and good assets are able to do so, and Seabridge's largest shareholder is FCMI, is Albert Friedberg. Albert is also a very large shareholder in Gold Standard, and was the lead order in our February financing, which brought him up to 19.9%. He's been incredibly supportive and patient, and that allowed us to make the final payment to Scorpio, and allowed us to have the time to deal with Oceana and be patient. But again, it's being tenacious. I mean, nobody's aggressive looking to deploy capital right now and pay up. People are looking to buy assets on the cheap. So it's having a focus. It's being tenacious, and it's really working with a team concept, which I think Gold Center does really well. We've got great advisors, and we've got some really good shareholders that have bought into what this district is.
Absolutely. Now a question from Mike from Texas. Is it cheaper to explore and drill today versus 5 years ago?
Absolutely. One of these.
Oh, I think we may have lost you for a second there, John. I think John's audio might have dropped out. We're just going to take oh, I think, yeah, no problem. I think we just lost you. So I'll just start from the top of the question there. Mike from Texas was asking if it was cheaper to explore and drill today versus 5 years ago.
Yeah, absolutely. I think that the mining companies, the explorers, actually have leverage, for the first time in years with the drillers, and it's a lot easier to keep them in line, because a lot of these drilling companies are fighting to stay solvent and are fighting to deploy rigs. So, I find now we're able to get much more experienced, more efficient crews, and it's much easier to be accountable for their productivity and their costs. So, absolutely. So, I mean, now is the time to be putting holes in the ground, because you're able to get things done for really a fraction of what it cost, 2 years ago, 3 years ago. We're going to be getting some quotes to bring a core rig in over the next month, and sort of the preliminary quotes are, probably 30% cheaper, 35% cheaper than they were a couple of years ago. So I think our struggle is going to be, as this market does turn, whatever that is, 3 months, 6 months, a year, is fighting with all of our trades and suppliers to keep those costs down. I think that's going to be a big part of of management's objectives, is to keep the costs here or keep driving them down for as long as we can.
Right. Now, that's about all for our viewer questions for now. John, I just wanted to ask you about your participation in the Sprott show coming up in 2 weeks. What are you hoping to achieve at the show there?
Well, look, it's a fantastic forum. I mean, the Sprott group, having Eric and Rick and Doug and the association with Stansberry, it's just a fantastic forum. It's one of the few places where there's a sophisticated audience of both people who are really involved and heavily invested in the precious metal space and natural resources, but in people who want exposure. And with the group of people that Sprott has and Stansberry there, you've got a wonderful collection of individuals with a wealth of knowledge, and experience, and one of the few groups on the planet that can still deploy capital into opportunities in the natural resource space if they want to.
Right, and they certainly can, and have some great companies at the show that you guys, investors will be able to come down and meet you and get to know the company a little bit more. And we wish you a great conference there. It's going to be in 2 weeks' time here in Vancouver at the Fairmont Hotel Vancouver, and starting on the 28th through the 31st. And investors can register to learn more about it. Well, thank you so much for being so generous with your time this morning, John. It was great to speak with you and have you join us on the call. And we'll look forward to having you back on in the future.
Thanks very much. It was a pleasure. Look forward to seeing you at the show.
Great. Thanks, John.
Thanks a lot. Take care.
Okay.